Well, despite warnings from the IRS of lower tax returns this year, a lot of us are relying on those refunds to stay afloat. That's according to a new Bankrate survey. It found roughly 75% of adults say this year's return is important to their financial situation. That is about 10% higher than last year. So this year, the first time since the start of the pandemic that the government will not give out extra tax credits or stimulus payments. So the IRS says the average refund amount as of February 17th, a little over $3,000. That is down 11% from last year. We're joined now by Darren Troutman, Wealth Management Advisor at Emerald Wealth, joining us with more. Good morning to you.
Hey, good morning.
So talk about how we maximize our tax refund. The deadline, of course, coming up April 18th. So what are some things that we can do to get a larger refund without the extra tax credits or stimulus payments?
Yeah, so a few things that you can do. First one, let's make sure that you do the easy things. Don't miss any of the check the boxes. You want to make sure that you're claiming all the dependents, for instance, on there. We still have that $2,000 tax credit on there, so that's even better than a deduction. So, you know, a deduction saves you maybe $300 to $500 in taxes. This gives you $2,000 back in your pocket. So make sure you do those right. Make sure you do the easy things like you're filing correctly. The IRS lets you file in 5 different ways. Either as an individual, as married filing separate, as head of household or widow. Just getting those things right in the basics really helps you make sure that you can maximize the refund.
A lot of people really like getting that big refund check, but in some ways that may not be the best strategy.
Yeah, we would always recommend for you to pay attention in maximizing your retirement accounts. The no-brainer easy thing that please you all should do is at least do up to what your employer matches. Above and beyond that actually gets a little bit interesting. Here's where we work with a lot of people to figure out. If you put money in on a pre-tax basis, it might save you money right now. But you also have the ability a lot of times to fund a Roth IRA or a Roth 401k. Now, that doesn't save you money in taxes right now, but it does grow completely tax-free. So your retirement self will be thanking you when you're pulling those dollars out along top of your pre-tax dollars, which will be taxed as income at a certain point. So there is a fine line of balance where we try to walk of saying, how much should we save now versus how much should we save later?
Are there some kind of filing tips and tricks that we might not know about that we can take advantage of?
Yeah, so always, if you can, we try to tell our clients to itemize your tax deductions. Now, the problem is the standardized deduction increased greatly. So now you have $13,000 standardized deduction per individual. So married household, $26,000. So a lot of people, when we talk about itemized with home interest and student loan interest and giving, they don't get above that $26,000. So what you can do is, let's say that you're giving donations, but it doesn't go above that $26,000. You could bring that forward into this year. You can fund what something's called like a donor advised fund with either cash or stock. Helps you save money on taxes right now. It still lets you do that annual giving on years forward, but it just lets you get above that threshold in 1 year. Save you a lot of money in taxes this year, and you can still do the giving as you're planning on over the next 3 to 4 or 5 years.
Darren Troutman with Emerald Wealth, thanks so much for joining us. We appreciate it.